Hi, Shay Russell here on behalf of mining.com.au. And in the lead up to the Mines and Money Connect Melbourne conference coming this June, I thought I'd sit down and have a quick chat with Hedley Widdop, who is an investment manager for Lion Selection Group. Now tell me, did I get your title right this time, Hedley?
Spot on, Shay. Some people call me all sorts of things. I don't mind being known as a bicycle collector or even a barista, but what I do during the day, you've nailed it.
Awesome. Now, we're not going to talk here about being a barista, although that does sound like an interesting hobby of yours. I'm here to talk about mining and the mining sector. Now, first and foremost, I want to talk about valuations. Now, we throw this word around a lot when it comes to the mining sector, but at the end of the day, the mining sector is quite broad. There's over 1,000 listed mining stocks on the ASX, and not all of them are worth the same thing. So tell me, I guess this is going to evolve into a two-part question. Looking across the big guys, the little guys, and the ones in between, are there any particular sectors that are going cheap right now? And furthermore, is the industry likely to recover at some point this year? Because the mining sector's been a bit kicked around this year.
Well, it's not just a two-part question, Shay. I mean, I could give you a 20,000-part answer to that, but I think the high-level response is things are going cheaper. If you're a small company, so if you're a micro cap and sit below the level of index inclusion, you're going cheap. But that doesn't mean you won't get cheaper either. And what's brought all this about is the amount of money which has been chasing investment opportunities in the mining space has begun to dry up. Now, you don't see a massive declination in the share prices of things like BHP and Rio. There's definitely institutional interest in those stocks, but the juniors, which is companies that have to raise money in order to do things because they don't have a revenue stream, they're suffering, and it's their valuations which are pulled away. Now, in some cases you could say, is it the golds, is it the lithiums, is it the this, is it the that? No, I think it's across the board. They've all seen a pullback. If you're discovering something, you might not feel that heat quite so much at the moment, but I think by and large, if you're small, it's pretty painful for you at the moment.
So moving on, you mentioned goldies. Now, talking about gold explorers, we're not meant to have favourites in the sector. However, in the past, gold explorers have actually been getting the most amount of capital to look for more gold. Do you see that trend playing out this year and into next?
Yeah, it's a good one because with the backdrop of inflation, there's lots of people who say, well, inflation's great for gold, and to an extent, it definitely is. But it doesn't always play out in a really linear fashion. You do find that when there's an inflation headline, people go looking for gold exposures, and whether that's them searching for a Newcrest, a Northern Star, an Evolution, or they go looking for something where you can get a bit more leverage in the discovery sense. I think to answer your question more directly though, if you're exploring for gold at the moment, the problem that you've got is that you're exploring for something and you need to raise money, so you come issue. There's people with levels of cash balance across the sector, but if you're exploring, you do have a fundraising coming in your future. And I think that is the issue. It's not so much that it's gold that you're looking for. There's just not much which is in vogue across the exploration space at the moment, other than the sort of real hot flavour of the month stuff, which comes and goes on about the same sort of rhythmicity. It doesn't stick around for long.
You make an interesting point in there, which is, when you've got inflation in the headline, it makes gold more attractive. But yet, you and I both know quite well that a gold company looking for gold today isn't guaranteed to find anything, but also it could take 10 years or even 15 years for a mine to come out of that exploration project. So how does an inflation headline encourage people to look to those tiny gold explorers?
Well, it's probably momentary, and I think that interest is probably getting captured by producers more so than it is explorers. But if there was a rush of blood which says, well, I've actually already got some Evolution in my pocket and some Newcrest, I'm about to lose my Newcrest because it might disappear into Newmont, so perhaps I start looking for something with a little bit more leverage to gold because perhaps the rush of blood has been brought about by, I think the gold price is going up. Now, if gold price goes up 10%, what am I going to make on my Evolution? It might be 15 to 20. But what am I going to make on an Explorer that's got, say, a little bit of gold in the ground already and some upside to that? I might be able to double my money. So I think that's probably where the encouragement comes from. But to be clear, I think money is probably more chasing the institutional level stocks if it's looking for gold exposure at the moment rather than explorers. I think the risk of an explorer is, I won't say understood, it's never understood, but I think it's quite well palpated at the moment by a lot of investors in the space.
So, well, while we're on the subject of goldies, I'm going to talk about mergers and acquisitions. Now, the gold, and this is also extended to base metals as well recently, but, in the last 10 years, or actually even 15 years, there's been quite a lot of activities of the big guys merging. Now, are we going to see that increase over the next couple of years? And is there any chance that it's going to filter down to some of the juniors that are looking for precious metals and base metals right now?
Yeah, that's a super question. And I'm going to get my numbers wrong here. So I'm just going to have to go with some generalities. But if you go back 20, 25 years and you looked at the proportion of some of the world's biggest equity indices and said, well, here's how much of that the gold sector is, or even how much of that the entire mining sector is. It wasn't large, but it was reasonably consistent. And the trend that's occurred in the last 25 or let's say 30 years is that a huge portion of everybody's share of the capitalisation of the big indices has been pinched by tech. It's come from, nowhere, and it's grown to be a huge dominating force. Some of the biggest companies on the S&P 500 are tech. In fact, I think you probably go down the top 5 of the S&P companies, they're tech companies, right? So they've come from nowhere, and they've shrunk the capitalisation of the index that the golds and the mining stocks have monopolised. Now, there are big pools of money which chase the big end of indices. They can't hold the entire S&P 500. They might own the top 100 or pick your level. So there's these mining companies which are falling off of the radars of the big investors, and to regain that, they need scale. And even if you've already got scale, like if you're already at Glencore, adding a tech to that gives you the scale that you might be able to creep up on that. If you're already a Newmont, to put daylight between you and number 2, you need to add Newcrest to it. So do you see a strategic attraction for those companies? I think the strategic attraction, to be honest, is just being a bigger company, having a bigger production base, and being on the radar. If the big institutions want gold, you need to be the biggest one. There's no point being the second, even if it's by a short way. So being absolutely the biggest company will help them a lot in terms of attracting that dollar if it's going to come to them. Will it flow down to juniors? Well, I think there's always a case for some of these companies that might have a process facility in a part of the world which is surrounded by an exploration portfolio, which at some point becomes attractive to them, either because their own resources and reserves have declined, or because there's something interesting happening on that exploration ground. And a great example might be something like Havieron in Greatland Gold, right next door to Telfer, which belongs to Newcrest, and it makes sense for the owner of that plant and the owner of that resource to be the same at some stage in the future. Now, I don't know who it's going to be. Will it be Newcrest? Will it be Greatland? But it makes a lot of sense for the two to find a way together. So it's an example of how a non-production junior, albeit a large capitalisation one, might be strategically interesting. But does a BHP say, well, we're interested in copper, so we're going to buy all of this exploration ground by going through an M&A exercise with juniors? I think probably not. I think it's far easier for them to put some money into JVs or some minority equity investments into those companies. But at the top level, I see those companies getting engaged in their own exploration concepts far more willingly. So I suppose the final part of that question is, do you see juniors coming together? We may well see juniors trying to come together to have a 1 and 1 equals 3 equation, where you get 2 small miners coming together to become a bigger company and try to attract some more institutional interest to their register. And I think that's a possibility. But for me, the biggest story in M&A at the moment is trying to grow onto the radars of the biggest institutions, and that's right at the top end of the cap scale.
Now, Hedley, in the last couple of years, we've actually seen a lot of juniors being able to raise capital, especially during 2020 when you would have thought they would have been starved for it. Tell me, have the juniors managed to suck out everything out of the market already? Is there any hope that they'll be able to attract more funds this year and maybe even into next year?
2020 and 2021 were huge years for capital raising, particularly in the sub-producer space. So if you're an exploration company, they were great years to be raising money. I can't remember which of the years it was, but I think probably 21, we saw records broken in terms of capital raised in Australia on TSXV, which are the 2 biggest global equity markets which support listed exploration companies. So they were great years. Typically, when you have big years, you have a tailing off afterwards. You never see 10 big years on the tail of each other where they hit bigger and bigger and bigger numbers. I think most equity markets can support a certain amount of capital raising in a year, and if you go well over that, then you tend to have a bit of a breather after it. But what I would add to that is that we've seen pretty strong commodity price growth in 2021 in particular, into the early stages of 2022 in some cases, and that hasn't compounded. So, we just haven't seen those commodity prices continue to run. We've seen a topping in things like copper. Gold is a bit of an exception, but if you look at what the gold price has done, it's incrementally crept up. It hasn't smashed anything. So without a commodity price lead, you often find that liquidity drops away, and then you've got to put the rest of the equity market overlay onto that, which is that liquidity across the board has seen interest rates going up. So the rate of return that you need to get from your equity investments has gone up in order to compete. We're getting 4.5% at the moment on the cash that we've got in the bank. So, you need to be getting 5 to 10% or better with a great deal of confidence to be able to say, well, let's make that an equity investment with it. So I think that's caused people to be hesitant, and we all know what the outlook is. Is there inflation? Is there recessions? Is there problems in the global economy? Until you can emphatically say no issues at all, then liquidity sits on the sideline. And so I think access to that is problematic, and the smaller you are, the harder it is.
While access to cash is going to become increasingly difficult for later this year, as you've just pointed out, tell me, are we likely to see companies have aggressive exploration plans to maximise the cash that they've got in the bank? Or do you think that they'll be a little bit more tight-fisted and hold on to their dollars knowing that it's going to be harder to raise in this market?
First part of the answer is the ones that have cash, feel comfortable with that, and they will approach the market with a bit of optimism and hope that it improves at the point where they need to raise money. If you're an exploration company and you have cash, you have to spend it. There is a very, very limited and very fine tightrope to walk, having cash and saying you're not going to spend it when you're an explorer, because you've raised that money on the basis that you're going to go off and try and find something. And then if you don't, it implies very strongly that you don't have any options on which to spend it. And that any valuation you have in your company capitalisation will start to disappear if you don't have news flow to support the reason that people have invested in it. So those ones that have cash have to spend it, which means they need to come back to the market at some stage. And the more and more companies that are coming back to the market with what looks like a desperation raise, the harder it gets.
Now we're moving on to, I think, my favourite question this time around, and this is battery metals, critical minerals, PGEs, rare earths. Now, these are very, I guess, hot words in the market right now. Everybody wants to have one of these metals to offer the market. Now, I think it was last year I was at a conference, I noticed that rare earths were back in fashion. I'm old enough and grey enough to remember when rare earths were back in fashion 10 years ago. Now, tell me, from your point of view, are any of these particular sectors on your radar, and is there any sort of company that you're more likely to be attracted to in this space?
We're looking at all of those commodity themes, and over the time that Lion has existed, which I think is now going on 26 years, we've seen many, many hot themes come and go. Some of them have turned into very large markets. I mean, the emergence of the iron ore market, which was a big market already in the mid-noughties, was just made much, much larger by the emergence of China as an enormous consumer of these things. So that's a theme from the past, which we watched, we dabbled with, but then on the tail of that, we've seen things like graphite and then lithium, rare earths. Uranium comes and goes. It has its year in the sun roughly once a decade, and they all have their time. Some of these are tied very, very closely to the decarbonisation and the electrification themes. And there's a lot that goes into them. But if you boil them down to supply and demand, it does appear as if over the coming decade, there's going to be growing interest in those for consumption, which means that more of them need to come out of the ground. In monitoring them, I have concerns about risk in any investment that Lion make. And when it comes to risk in an exploration company, you're already taking risk. Will they find something which is big enough? So you don't really want to be adding to that risks like, am I going to come to market with a product that I can't sell? Am I going to come to market with something which I can't extract economically from the ground in great enough quantities to be able to interest the market with it? So I look at things like lithium. The lithium market has been flooded with supply recently. There's been a little bit of a backing off of demand, and we've seen that manifest in the price. Now, how that evolves from here, I think it's going to be difficult to read because it's still a small and tight market. You bring one big project on, you'll flood supply again. But let's just boil it down to lithium companies. Extracting lithium is a lot like extracting copper. You take very similar risks in the processing. I think that's becoming far better understood, and you're selling one product with very well-known quality considerations. So lithium, I feel, carries the risk of a copper project in many cases. So very interested in that. On that basis, it seems to have a lower risk than something like, say, rare earths. Assessed a lot of rare earths projects in the past 12 to 18 months. Haven't found one that I could say, wow, this one stands out as having none of those risks. When you extract rare earths, you've got to sell about 10 to 12 different revenue streams. 2 to 3 of them might matter most to you, but they're still not going to carry you over the line. You're dependent on everything which is in your basket of products there. And they're tremendously difficult metallurgically to pull out of the ore. There's a lot of discussion about ionic rare earths. People are finding them in clays. Ionic is a word that most people don't understand, but what they're referring to is a deposit style that's extracted in China, and you put a chemical on, the rare earths come out very easily. Most of what's been found that are called ionic rare earths don't look like they respond in quite the same way or anything near it. So I'm seeing those as being quite difficult in terms of both the metallurgy and the marketing. It's not to say that I won't be proven wrong, but so far it looks as if a lot of those are. PGEs are, very attractive in terms of the demand outlook, but when it comes to selling them, you need to either sell a concentrate that includes a few PGEs to a smelter, and the smelter might not give you anywhere near 100% of the value of the metal which is in that. In fact, I think it's probably going to be closer to 50%. So you then got the offset, do I need to build a smelter for myself? So your CapEx goes way up, and the technical complexity of smelting of those is going to be hard for someone trying to develop anything from a greenfield stage. So all of those things, I think they're very interesting, but I think you've really got to pick and choose from the risk perspective. And lithium rises to the top there as being one of the new ones, which is probably going to be the easiest to invest in from a pre-production stage, which is where I look.
Now, just drawing our interview to a close, I have a 60 seconds or less, a question that I expect you to answer in 60 seconds or less, which is greatly unfair when talking about something as complex as the resources space. Now, unfortunately, I don't have my phone to use as the stopwatch, so I've got something happening on my computer screen. So I assure you that I will be tracking this answer. Tell me, let's pop our retail hat on right now. Let's pop our retail investor hat on right now. If you are a resource investor, what is one of the most important things that you need to consider when it comes to investing in resource stocks starting now?
The most important thing you need to consider as a retail investor when you're investing now is what's the price going to be at the point where I start to get interested in selling or collecting value from this. And a lot of retail investors have either an exceptionally long time frame, almost infinity, because they forget about it, or it's like a 3-month time frame because I'm dependent on some news flow to turn this over. News flow is not having a great deal of effect on market prices for juniors at the moment. So you then need to cast your mind to, well, what's this going to be worth in the future? And the biggest sensitivity on the price of something a long way into the future isn't a commodity price. It isn't what you've found. It isn't how high grade you are. It's the price of dilution. So the next capital raise, if you're putting money in now at 10 cents, if you think the next capital raise is going to be anything less than 10 cents, then you're probably going to find yourself diluted pretty quickly. So I think that's the biggest thing that retail shareholders need to think about is what price will they be able to raise money at next time?
59 seconds. Well done. I'm very impressed, actually. I'm very impressed. All right, Hedley, thank you very much for being here today. As always, it's a pleasure to chat to you and share your insights with people. And for everybody watching today, if you'd like to see more of Hedley's investment insights, you can actually join him at the Minds and Money conference, Minds and Money Connect Melbourne conference in June on the 14th and 15th of June this year.
See you there.